Preparing for a financial analyst at EDP interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at EDP? I want to join EDP because it combines rigorous financial analysis with a business that is reshaping the energy system. As an analyst, I would enjoy linking operational drivers such as generation, prices, capacity factors, and investment timing to earnings and cash flow. EDP's renewable portfolio also creates interesting scenario analysis challenges around regulation, financing, and market volatility. I would bring strong Excel, accounting, and communication skills, while developing a deeper understanding of infrastructure and sustainable growth economics. While answering, connect your analytical skills to EDP's renewable energy strategy, regulated utility operations, capital intensity, and international footprint. Show enthusiasm for combining financial discipline with the energy transition and explain the specific value you would bring. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and profit over a period. Net income flows into retained earnings on the balance sheet and starts the operating section of the cash flow statement. Depreciation reduces accounting profit but is added back in operating cash flow, while capital expenditure reduces cash and increases property, plant, and equipment. Debt affects the balance sheet and financing cash flows, with interest affecting earnings. I always check that the balance sheet balances and cash movement reconciles. Make sure to cover the income statement, balance sheet, and cash flow statement. Explain net income, working capital, depreciation, capital expenditure, debt, and retained earnings. Include how a financial analyst uses reconciliations to detect inconsistencies. Question 3. How would you build a monthly forecast for an energy generation business? I would begin with asset-level operational drivers rather than extrapolating total revenue. For each plant, I would forecast available capacity, expected generation, outage days, contracted volumes, and merchant prices. I would then model operating costs, maintenance, power purchase agreements, foreign exchange, and corporate expenses. After consolidating entities, I would compare actual results with forecast, investigate volume, price, and cost variances, and update assumptions with operating teams. That approach makes the forecast explainable and actionable. In your answer, talk about asset-level production, capacity factors, realized power prices, contract structures, operating costs, maintenance outages, foreign exchange, and management assumptions. Emphasize driver-based forecasting, variance analysis, and clear documentation. Question 4. What are the most important KPIs for a renewable energy company such as EDP? I would monitor installed capacity, generation, capacity factor, availability, curtailment, and achieved power prices at the operating level. Financially, EBITDA, EBITDA margin, operating cash flow, capital expenditure, net debt, leverage, and return on invested capital are important. The relationships matter. Lower availability reduces generation and revenue, while higher prices may offset weaker production. I would also track contracted versus merchant exposure because it changes earnings volatility and the appropriate risk interpretation. Be sure to mention installed capacity, generation, capacity factor, availability, realized price, EBITDA, operating costs, leverage, cash conversion, and return on invested capital. Distinguish operational indicators from financial outcomes and explain how they interact. Question 5. How would you analyze a variance between actual and budgeted EBITDA? I would bridge budgeted EBITDA to actual EBITDA using consistent categories: volume, price, mix, foreign exchange, operating costs, timing, and exceptional items. For a wind portfolio, I might separate generation below plan from lower realized prices and unplanned maintenance. I would reconcile the analysis to the general ledger and operational reports, then discuss unusual movements with plant and commercial teams. Finally, I would identify whether the variance is temporary or structural and update the forecast accordingly. Focus on decomposing the variance into volume, price, mix, foreign exchange, operating cost, timing, and one-off effects. Explain how you would validate data, speak with business owners, quantify causes, and convert findings into forecast improvements. Question 6. Explain the difference between EBITDA, EBIT, and operating cash flow. EBITDA is earnings before interest, tax, depreciation, and amortization, so it highlights operating performance before non-cash asset charges and financing choices. EBIT includes depreciation and amortization, reflecting the cost of using productive assets. Operating cash flow starts with accounting profit and adjusts for non-cash items and working capital movements. EBITDA is useful for comparing operating performance, but it is not cash flow because maintenance capital expenditure, taxes, interest, and working capital still consume cash. While answering, define each measure, explain depreciation and amortization, distinguish accounting earnings from cash generation, and note limitations. Mention why analysts use EBITDA in capital-intensive utilities but still rely on cash flow and debt metrics. Question 7. How would you evaluate a proposed renewable energy investment? I would build an unlevered project model using development, construction, connection, operating, decommissioning, and tax cash flows. Revenue would reflect expected generation, degradation, contracted prices, merchant exposure, and curtailment. I would calculate NPV and IRR using an appropriate discount rate, then assess leverage separately. Sensitivities should include power prices, capex overruns, delays, interest rates, capacity factors, and operating costs. I would also consider permitting, grid access, counterparty strength, and strategic fit. In your answer, talk about project cash flows, development and construction costs, generation assumptions, power prices, operating expenses, taxes, financing, NPV, IRR, payback, sensitivity analysis, and strategic fit. Include downside cases and execution risks. Question 8. What is the difference between NPV and IRR, and which would you prioritize? NPV is the present value of forecast cash inflows less the present value of investment, using a required return. IRR is the discount rate that makes NPV equal 0. I would prioritize NPV when comparing mutually exclusive projects because it measures absolute value creation and handles scale better. IRR remains useful as a communication metric, but it can mislead with unusual cash flow patterns, multiple solutions, or different project sizes. I would present both alongside sensitivities. Make sure to explain that NPV measures absolute value creation while IRR measures percentage return. Discuss discount rates, project scale, reinvestment assumptions, mutually exclusive projects, and why NPV generally provides the stronger decision rule. Question 9. How do higher interest rates affect EDP's financial performance and valuation? Higher rates can increase interest expense on floating rate debt and raise refinancing costs when maturities are renewed. They also increase discount rates, reducing the present value of long-duration renewable projects and potentially making marginal investments less attractive. The impact may be moderated by fixed-rate debt, interest rate swaps, regulated returns, and contracted revenues. I would quantify exposure by maturity and hedge profile, then stress test EBITDA, cash flow, leverage, covenant headroom, and project NPV. Be sure to mention floating rate debt, refinancing, discount rates, project economics, valuation multiples, hedging, regulated returns, and investment pacing. Distinguish immediate income statement effects from longer-term valuation and financing consequences. Question 10. How would you forecast cash flow for a capital-intensive utility? I would start with EBITDA and convert it into operating cash flow by incorporating taxes, working capital movements, provisions, and cash interest. Next, I would separate maintenance capex from growth capex, identify committed versus discretionary projects, and include asset sale proceeds, debt movements, dividends, and equity funding. I would forecast monthly liquidity and debt maturities, then test downside cases for lower generation, prices, delays, and higher costs. The result should support financing and capital allocation decisions. Focus on EBITDA, taxes, working capital, maintenance and growth capital expenditure, financing flows, asset sales, dividends, and liquidity. Explain the distinction between committed and discretionary spending and how cash conversion supports funding decisions. Question 11. What is working capital, and what drivers would you monitor at EDP? Working capital represents short-term operating assets and liabilities, commonly receivables, inventory, and payables. At EDP, I would monitor customer collections, billing cycles, wholesale market settlements, supplier payment terms, fuel or equipment inventories, collateral, and tax balances. A rise in receivables may reflect growth, seasonality, or collection weakness, while higher payables could improve cash temporarily but create supplier pressure. I would analyze days metrics and distinguish sustainable improvements from timing effects. In your answer, define receivables, inventory, payables, and operating cash conversion. Relate the analysis to electricity billing, government or corporate customers, supplier terms, collateral, seasonality, and timing differences between production and settlement. Question 12. How would you assess the impact of a power price decline on earnings? I would first map exposure by market, asset, contract type, and settlement period. A price decline should affect merchant generation directly, while contracted assets may have protection through fixed prices, floors, or hedges. I would combine price scenarios with expected production and calculate impacts on revenue, EBITDA, cash flow, leverage, and covenant headroom. I would also test whether lower prices reduce input costs or trigger contract effects. The analysis should identify both vulnerability and available mitigation. Make sure to separate contracted and merchant exposure, model generation volumes, hedges, pass-through mechanisms, geographic markets, and price floors. Explain sensitivity analysis, EBITDA impact, cash flow consequences, and management actions. Question 13. What accounting issues are especially relevant for energy companies? Energy companies face significant accounting judgments because assets are long-lived and transactions can be complex. Important areas include capitalization and depreciation of plants, impairment testing, lease accounting, decommissioning provisions, power contract revenue recognition, derivative valuation, and hedge accounting. I would also consider consolidation of jointly controlled projects and the treatment of government incentives. As an analyst, I would understand the accounting policy, challenge unusual movements, and ensure operational assumptions support reported balances. Discuss property, plant, and equipment, depreciation, impairment, leases, provisions, revenue recognition, derivatives, hedge accounting, decommissioning obligations, and consolidation. Emphasize judgment areas and the importance of coordinating financial and operational data. Question 14. How would you explain a goodwill impairment test in an interview? A goodwill impairment test compares the carrying value of a cash-generating unit, including allocated goodwill, with its recoverable amount. Recoverable amount is the higher of value in use and fair value less costs of disposal. Value in use depends on forecast cash flows, terminal growth, and a risk-adjusted discount rate. I would focus on forecast quality, market assumptions, and sensitivity headroom, because higher rates, weaker prices, or underperformance can quickly eliminate protection and create a non-cash charge. While answering, cover cash-generating units, carrying value, recoverable amount, value in use, fair value less costs of disposal, discount rates, terminal growth, headroom, and sensitivity analysis. Link impairment risk to rates, prices, and operating underperformance. Question 15. How would you evaluate whether a forecast assumption is reasonable? I would triangulate the assumption using historical performance, current operational data, external market forecasts, contracts, and comparable assets. For example, a projected capacity factor should reflect resource studies, outage plans, and recent availability rather than simply repeating last year's result. I would ask the business owner what changed, document the rationale, and test the assumption in downside and upside cases. My role is to challenge constructively, preserve accountability, and make uncertainty visible to decision makers. Be sure to mention historical performance, operational evidence, external market data, management plans, contractual support, peer benchmarks, and sensitivity analysis. Explain how you would challenge assumptions professionally without replacing ownership by the business. Question 16. Tell me about a time you found an error in a financial model or report. In a monthly reporting exercise, I noticed that forecast operating expenses were unusually low despite stable activity levels. I traced the variance to a formula that excluded one business unit after a range had not been extended. I compared the model with the general ledger, corrected the formula, quantified the reporting impact, and informed my manager promptly. I then added a completeness check comparing model entities with the reporting hierarchy. That experience reinforced the value of reasonableness tests, not just formula review. In your answer, use a clear situation, action, and result structure. Explain the control or analytical check that revealed the error, how you isolated root cause, communicated the issue, corrected it, and prevented recurrence. Question 17. How would you improve a financial model that is difficult for others to use? I would first map the model's purpose, users, outputs, and key data sources. Then I would separate assumptions, calculations, and outputs, standardize formatting, simplify repeated formulas, and add checks for balance, completeness, and unexpected movements. Scenario control should be obvious, while hard-coded values need labels and source documentation. I would test the revised model using independent inputs and compare outputs with the original. A good model is not merely accurate, it is transparent, scalable, and reviewable. Focus on clear structure, consistent formatting, separate inputs and calculations, transparent formulas, error checks, scenario controls, documentation, and version discipline. Mention balancing usability with auditability and testing the model with an independent user. Question 18. How would you present a complex financial analysis to a senior executive? I would lead with the conclusion and quantify the decision's financial impact before explaining the supporting drivers. For example, I might state that a project remains value accretive under the base case but loses its target return if construction costs rise 10%. I would show a simple bridge and focused sensitivity table, then identify assumptions, risks, and my recommendation. Detailed calculations would remain in backup materials. I would tailor the message to the executive's decision, not the model's structure. Make sure to cover the headline conclusion, business impact, key drivers, assumptions, risks, recommendation, and requested decision. Explain how you would use concise visuals, avoid unnecessary detail, and retain backup analysis for follow-up questions. Question 19. How would you analyze an acquisition or partnership involving a renewable energy portfolio? I would assess strategic fit first, then review asset quality, generation history, resource assumptions, permits, grid access, contracts, counterparties, and operating obligations. Financial analysis would include standalone and synergized cash flows, purchase price, debt assumed, taxes, capex needs, NPV, IRR, leverage, and accretion or dilution. I would stress test power prices, availability, inflation, construction requirements, and refinancing. Finally, I would identify integration and regulatory risks before recommending a valuation range or transaction structure. Discuss strategic rationale, asset quality, generation, contracts, valuation, synergies, liabilities, financing, integration, regulatory approvals, and return metrics. Include due diligence on forecasts, permits, grid access, counterparties, and environmental obligations. Question 20. What would you do if operational data and financial data did not agree? I would not force the numbers to agree without understanding the difference. I would first confirm period, entity, units, currency, and recognition timing, then reconcile operational volumes to billing, general ledger revenue, and settlement records. I would involve operations, commercial, and accounting teams to identify outages, estimates, cutoff issues, or system mapping errors. I would document the resolution, quantify any reporting impact, and add a recurring reconciliation or control so the issue is detected earlier next month. Be sure to mention pausing conclusions, defining the period and scope, reconciling source systems, checking units and timing, involving operations and accounting, documenting adjustments, and strengthening controls. Emphasize accuracy before speed while meeting reporting deadlines. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.